Political turmoil hits the UK and the markets are reacting in a very interesting way. Following Keir Starmer's shock resignation on Monday, pound dollar is pushing higher, shaking off the political noise. But the volatility doesn't stop there. Flash business PMI data out of the UK and Europe are about to redraw the map for both pound dollar and euro dollar, while the upcoming US Core PCE price index will test just how seriously the markets should take the Fed's recent hawkish signals. So let's dive straight into the charts and see what does this mean for those markets. So having a look first at pound dollar, we can see that the pair is trading positively despite Starmer's shock resignation. It seems that investors are hoping for some political stability after a couple of fiscal challenges during Starmer's leadership. There is also a favorite candidate to replace Starmer, Manchester Mayor Andy Burnham, who won last week's by-elections, could easily replace him if there is no candidate until July. So the announcement could come as soon as next month, or if there are any other candidates to compete for the position of the new prime minister. Well, we may have a new leadership probably in September after the UK Parliament returns from its summer break. So does this mean that the political uncertainty is over in the UK? Well, probably not. We will need to wait and see what the fiscal agenda of the next prime minister will be, and how he's going to manage his leadership on the defense front. So uncertainty remains, but in the meantime, the headlines provide support to the British pound, and from a technical perspective, we can see the price retesting this former broken support trend line drawn from November 2025 near 1.3240. So we need a clear break above that in order to continue up to the 1.3325 barrier, and then beyond that, a bigger battle could take place somewhere between 1.34 and 1.3430, where this descending trend line is located. So we can see the 50 and 200-day moving averages also converging towards that zone. So that could be a critical test for the market. Now, besides political headlines, flash business PMI figures out of the UK on Wednesday could also provide some volatility, could also fuel some volatility into this market. Expectations are for an improvement in the services sector, and if that proves to be the case, or if the data arrive stronger than expected, probably that could act as a tailwind for pound dollar. Now, if the data surprise to the downside, and if new political headwinds hit the UK, probably the price may reverse to the downside to retest the 1.3160 low from Friday, where the price also bounced up in late March. Failure to hold here could extend this negative pattern towards the 1.3090 or lower towards the 1.30 psychological mark. Now looking at euro-dollar, well, this pair will also face flash business PMI figures on Wednesday, and traders may be more sensitive to the European business PMI release, as Eurozone faced a slight contraction in the first quarter of 2026. Well, the data are for the month of June, so they could provide some insight about economic growth at the start of the second quarter. So if the data disappoint, we could see euro-dollar moving lower. We could see growth risks returning in the Eurozone, and the euro-dollar falling below 1.1420 and 1.1390, in which case we could target the next support at 1.1275. However, if we look at the technical signals here, well, we do have some oversold signals from the RSI, the stochastic oscillator. Pound dollar also is also facing oversold signals, so that suggests that perhaps a rebound could be around the corner, especially as euro dollar is testing its 3-month lows from March as well. Perhaps forecasts about PMI suggest that there might be some improvement in the services sector, even though the data could remain in the contraction area. Nevertheless, any progress in the data could help the pair to head higher and perhaps even reach the 1.1580 or 1.1590 territory, where where a couple of key resistance trend lines are located. We can see the 20-day moving average also passing through this region. So a break above that could be important in order to test the 1.1680, where this broader, longer-term resistance trend line from January is located. We can see the 250-day moving average is also placed here near 1.1680. So that could be a more important barrier for the market, in order to, well, a break of which could actually trigger a faster rally up to 1.1760 and 1.1780. Now, looking to the downside, so well, if the 1.1420 and 1.1390 region fails to hold in the event the data surprise to the downside, well, the 1.1275 number could come next into view, actually putting this negative trend back into play. And finally, looking at the gold, which is pushing for some recovery following Fed's hawkish signals last week. The odds for a rate hike are back into play, and that could shift attention towards the next important release, the Core PCE index due this Thursday. Expectations are for the core measure to face a slight strength to 3.4% from 3.3% previously. If that proves to be the case, or if the data surprise to the upside, well, that could suggest that perhaps the Fed's hawkish stance is the right thing. Well, actually, the Fed could actually prioritize its price stability in the coming months. Otherwise, weaker than expected figures could help precious metal to recoup some losses, perhaps retest the 4,380 or even the 4,465 and 4,530 territory, where the simple moving averages are located. A successful penetration higher from here could actually take us up to the 4,740 and 4,800 territory. Now, well, if we look at the weekly chart, we can see that the price has already closed below its 50 weekly moving average. So that's a bearish signal, especially if we get another red candlestick later this week. If we look at the technical indicators in the daily chart, it seems that the price is still in bearish territory, so a negative correction is still likely. And looking to the downside, the next support could be near the 3,930 and 4,000 number, a break of which could actually see a bearish continuation towards the 3,800 level, or even down to the 3,670 number last seen back in September 2025. So that's everything I wanted to share with you guys. Thank you for watching. We'll be back on Thursday for more technical updates. So stay tuned, and we'll be back soon with more technical insights. Bye bye for now.